I'd just like to say a quick thank you to our podcast sponsor, PensionBee, the UK's leading online pension provider. PensionBee can help you transfer most old pensions together into one new online plan, so you'll know exactly how much you've saved and where to find it. If you are looking for a low-cost, hassle-free way to consolidate your pension pots, excluding final salary pensions, then PensionBee is worth considering. When you transfer your pensions, you can pick from a range of purpose-built pension plans, and if you want to contribute more to your pension, you can do that too. A combination of investment fund performance, low costs and excellent customer service have clearly been integral in PensionBee gaining over 265,000 customers, over £6 billion in assets and an excellent rating on Trustpilot. You can sign up in minutes with the names of old employers or providers. As always with investments, your capital is at risk.
Hello and welcome to episode 498 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, 498. We're so close to that 500.
We are, and it's really, it's hard to believe really. We've done nearly 500 episodes, and just to reiterate to people out there, we are going to be doing a special episode for the 500th. We're going to be recording the show in London in a podcast studio that we're renting out, where you can come and actually meet us if you want to as well. And Andy's got the details.
Yeah, so on Tuesday, the 25th of March, we're going to be recording at Spiritland between 5 and 6 p.m. You can come along and meet us at Spiritland if you wish, but do be mindful that the bar area is quite small. So I think probably the best thing to do is maybe leave it to around about 5:30, 6 o'clock to come along to Spiritland, which is near King's Cross. And then what we'll be able to do is meet you, say hello, and we'll take you along to a bar that will have a few more drinks on a little later in the evening, maybe up until about 8 or 9 p.m.
Yeah, and if you are in the area, then do come along and say hello, because it'd be nice to meet people. But we will be putting out details on our socials anyway during that evening if we're out and about. So people who can't obviously make it for the recording, but they can come down and join us for a drink. During the recording, we will be in a studio. We'll be able to see you actually through a window, but it is a soundproof booth, so bear in mind we won't be able to interact with you while we're recording the show, and you probably won't be able to hear us actually, but some of the Money to the Masses team will be around and you can chat to them as well until we are finished.
Yeah, and Damien, you mentioned about interacting with us. What I would like listeners to do, if possible, we do have a WhatsApp number, so a number that people can either send us a message on, but ideally what we would love is people to leave us a message for our 500th show. So however long you've been listening to the podcast, we would love you just to give us a few words of congratulations, or maybe even just letting us know how the podcast has helped you in your personal finance journey. It'll be really good to hear those stories and actually play those out on the podcast. So that number is 0208 163 3629. I'll say it again. It's 0208 163 3629. If you set that up as a WhatsApp contact, you'll see straight away the Money to the Masses logo, so you'll know it's us that you're conversing with. And yeah, please do just send us a message. It'll be great to hear those. And by sending us a message, that's you giving us permission to use that on the podcast or socials going forward.
Yeah, and when Andy says a message, ideally we'd love voice notes so we can actually play it out on our 500th show or on our social channels. So Andy, with that out of the way, what's on this week's show? Well, we've got an end of tax year checklist to run through, which is all of the things you should probably be thinking about before the 5th of April. Then I'm going to be talking about a development this week in the car finance mis-selling scandal that's unfolding. There's some bits and pieces that have happened that you want to know about and dates for your diary. And then, Andy, you're going to be doing a final piece about Chase Bank.
Yeah, that's right. So Chase Bank has been well known for having a generous cashback scheme. And over the years, that has changed. But there's a significant development that's happening with their cashback scheme in April. I'll be explaining exactly what that is, what that means for customers who are already Chase customers, but also people who are considering Chase, whether there are actually some alternatives that might better suit them going forward. Okay, so let's crack on with the first piece of the podcast.
So I'm going to run through a checklist of all the things you should be thinking about ahead of the tax year deadline. So the 5th of April 2025 is when the tax year ends. There's a number of things you should be thinking about with your personal finances, particularly to do with tax allowances. Now, all of the things I'm going to mention, I'm going to put links in the notes so you can read more about it. Now, picking the first thing to think about, pension contributions. Now, In any given tax year, you can pay in pension contributions up to the value of 100% of your earnings, or the cap of £60,000, whichever is lower, or it can be £3,600 gross if you don't earn anything at all. So that means you can make a net contribution of 2,880 and you get tax relief of 20% on that, taking it to 3,600. So make sure, if you're thinking about making pension contributions, that you do so, because your annual allowance will obviously reset when you get to the 6th of April 2025. Now, there are various reasons why you might want to make a pension contribution, not just because you're trying to boost your pension pot, but also there are people who can benefit from making pension contributions if they are trying to restore certain allowances. So, for example, people who earn over £100,000 a year have their income tax personal allowance reduced by £1 for every £2 they earn over £100,000. So, by making pension contributions, it is possible to restore your personal allowance. We'll put details in the notes, as I've already mentioned. Also, those people who claim child benefit, where one of you is earning over the £60,000 threshold, then your child benefit can be reduced. So if you're a couple, that is important that you look at that, and pension contributions can be one way of ensuring that you get the full child benefit for that tax year and you don't get charged the high income tax charge that's related to child benefit. So that is something to bear in mind. Again, links in the notes. If you are somebody who is a high earner and you're paying a pension contribution, so you may be an additional rate or higher rate tax payer, then do make sure you make a note, because you need to claim that additional tax relief when you come to do your self-assessment in January 2026. Now, talking about pension contributions, you might want to think about carry forward pension contributions. So if you've not used your annual allowances in any of the last 3 years, it is possible to carry forward those unused annual allowances. And so you could theoretically pay more than £60,000 into a pension in this tax year and get that full tax relief. So that's one thing to bear in mind if you're thinking about maybe using the carry forward rules in the future and you're not a member of a pension scheme, then it's worth making a pension contribution into a personal pension just to make sure that you have something that you can use in the future. Now, the other thing you can think about when it comes to pensions is a spouse's pension, even if they're a non-earner. So if they are a non-earner, then you can pay a contribution into their pension and they will get that tax relief that I mentioned earlier on. So $2,880 is the amount you can pay in, even if they're not earning any money, and they can get £720 from HMRC in tax relief, taking it up to £3,600 gross. You can also do the same thing for children. So you can pay into a junior SIP, for example, pay £2,880 for this tax year and get that additional tax relief for them, even obviously they're not earning any money. While on the subject of pension, don't forget you can boost your state pension. If you have any gaps in your national insurance record, you can check that by taking out a state pension forecast. There's a link in the notes. You can see if you've got any gaps on your national insurance record. If you do, you might not get the full state pension when you get to state retirement age. And you can plug gaps by paying voluntary national insurance contributions now. And the reason it's particularly important in this tax year is because there is a deadline at the 5th of April, whereby if you pay those contributions, plug those gaps, you can do it as far back as 2006. From the 6th of April 2025, you'll only be able to go back as far as 6 years. Moving on to investments, don't forget to use your annual ISA allowance. If you can shelter up to £20,000 in a stocks and shares ISA, a cash ISA, a lifetime ISA, innovative finance ISA. That £20,000 limit is across all of them. And don't forget there is a £4,000 limit on a lifetime ISA. So if you are trying to save for a house, you might want to use that allowance. So you get the £1,000 government bonus. We'll put a link in the notes to the best cash ISA rates out there for people who are interested. You can still get around about 5% at the moment on cash ISAs, so it's still worth using them. And of course, talking about ISAs, junior ISAs have their own separate allowance. So don't forget you can pay £9,000 into a junior ISA for your children. That again is an allowance that resets each year. It's a use it or lose it allowance. Moving on to capital gains tax, don't forget you've got a capital gains tax allowance of £3,000. So you might want to consider selling any investments that you've got that are in profit so you can therefore use your annual allowance and therefore not have to pay capital gains tax on that money that you have liquidated. Don't forget there's the bed and breakfasting rules as well, which mean that you could, for example, sell down some unit trusts that you have and you actually use your annual allowance. And as long as you don't buy that same investment for 30 days, it's considered that you've used your annual allowance, and the gains then reset from the point when you buy back the exact same investment, if you so wish to, in 30 days' time. Then it's also worth thinking about the bed and ISA rule. So that's where you can use your capital gains tax allowance, for example, and you might sell down some investments to try and move them into your ISA, so moving the money into that tax-free environment. And you can utilize your capital gains tax allowance to offset any gain that you may have incurred. A number of platforms will actually allow you to do that at a click of a button, but you need to do that early enough. Most of them have a cut-off that is towards the latter part of March, so make sure you look out for that deadline. Now, I'm going to throw this in there just for completeness. It's only for sophisticated investors and probably for people who seek advice, but you may be interested in EISs and VCTs, so that's enterprise investment schemes and venture capital trusts, which have huge tax breaks for people who use them, invest in them, and they are tax year sensitive, so that's something to bear in mind. I talked about capital gains earlier, but capital losses are something to bear in mind as well, because you could use capital losses deliberately if you liquidate a particular asset to offset any gains you've got somewhere else if you are trying to mitigate tax. You can also carry forward excess capital losses, but you have to remember you've got to declare them on your tax return within 4 years. So that's something else to bear in mind. Have you got capital losses from past tax years? Next, you might want to think about the dividend income allowance. So there is an allowance whereby you can be paid £500 tax-free via dividends, but it's also interesting for people who may be directors of a limited company, for example. If they haven't paid themselves dividends, they might want to look at that allowance and use it for tax mitigation purposes. It's also important if somebody is a director of a business, if they are thinking about maybe applying for a mortgage later on in the year, they probably have the ability to manage their income levels and the amount they pay themselves. So do bear in mind that the lender might want to look at your earnings, including dividends, for this tax year, even if you are looking at taking out a mortgage later on in the calendar year. Marriage tax allowance is something to also think about. If your spouse has an unused personal income tax allowance, then you may be able to use it by claiming a portion of their income tax allowance and applying it to your income. So it means you can transfer £1,260 of their allowance, which ultimately can reduce your tax bill by about £252 in the current tax year. I'll put a link in the notes to who can claim the marriage tax allowance, but in simple terms, you have to be married or in a civil partnership. One of you has to not have any income or an income that's less than the annual tax allowance of £12,570, and the other person has to be a basic rate taxpayer, which means that you earn between £12,571 and £50,270. But interestingly, if you suddenly realise that you are eligible and you've never claimed, you can backdate claims up to 5 years. So some people get quite a windfall of over £1,000 by backdating claims. So make sure you check whether you can claim that particular allowance. Also, moving on to inheritance tax now, there are a number of allowances that you want to look at. So if you are somebody who's feeling generous and you have money to spare, you can pass on £3,000 in a tax year and it be exempt. And you can also carry an unused allowance forward 1 year, but only 1 year. There are other smaller allowances, so you can give up to £250 a person away in a given tax year and it not be applicable or liable for inheritance tax. But that can't be used in conjunction with any other inheritance tax allowances. Also, you can give £5,000 to a child who's getting married and £2,500 to a grandchild or great-grandchild getting married. And it's worth pointing out, although not tax year specific, that regular gifts from income are IHT free. Most people don't realise, as long as it doesn't diminish your standard of living. So that's a list of things to think about as we approach the tax year end. And there's a link in the notes where you can see a full list of all the things to think about, and you can read it at your own leisure.
Okay, the next piece of the podcast then, Damien, there's been a bit of an update in terms of the car finance mis-selling scandal. There's some details that people should be aware of. Nothing finalised yet, but definitely worth bringing to the podcast.
So this week there's been huge news in relation to the car finance mis-selling scandal, which at the moment is in its very early stages. Nobody's been paid out as yet. But the news this week could mean that we could end up with an automatic compensation scheme being put in place, which would mean that millions of people could potentially be paid out without even having to make a complaint, with the onus being on the lender to contact people and tell them if they are due some form of compensation. So what's the latest then? Well, the FCA has indicated they're likely to consult on an industry-wide redress scheme. Now, this would mean that if they found that there was widespread failings by finance firms, and those firms would therefore be required to compensate affected customers. And it'd be those who haven't even filed a complaint. So what are these failings? Well, they principally relate to car finance arrangements that occurred before the 28th of January 2021. Before that date, you could have car finance arranged by a lender where you actually charged a higher rate. So the car dealers could set the interest rate and were incentivized to offer higher rates for higher commissions. And so therefore it was felt that people were actually being treated unfairly. So the FCA has been looking into this, and we are now at the point where we are getting to a stage where there could be this industry-wide compensation scheme. So the waters have been muddied somewhat by a decision in the Court of Appeal at the end of last year in relation to the disclosure of commissions that brokers receive. Ultimately, it means that there is now a case being heard by the Supreme Court at the beginning of April, which could mean that cases where people weren't probably disclosed or informed about the commission that the brokers were receiving could fall under this redress scheme, which would be huge. It means that the FCA is waiting for the Supreme Court's decision before determining if customers lost out due to the failings that were not just because of the DCA arrangements I've already mentioned, but also because of the lack of disclosure. That will have a massive impact, and the cost will run into billions for the lenders. So the most likely outcome is probably that the DCA arrangements will be covered under any scheme that the FCA decides upon. But the FCA has said that it will make a decision within 6 weeks of that Supreme Court decision. So does that mean you no longer have to bother to complain, if you've not got around to it yet, about car finance that you had prior to 2021, that you don't really know whether it did or didn't have one of the DCAs within it? Well, technically you could wait and see, because you might just be compensated anyway under this new scheme if it is automatic. But the FCA is still suggesting that you do put a complaint into the lender. You don't complain to the car dealership, it's the lender who arranged the car finance. Now, there's a tool I'll link to that you can use on the Money Saving Expert website, which uses a template to make a complaint letter that you can use. You don't even have to know all of the details regarding the car finance arrangement, but you just need to know who it was with, and you can look at your past paperwork to find that out. You should receive a response in 8 weeks, ideally. If you do get a response to your complaint and you're still not happy with it, you can then lodge a complaint with the Financial Ombudsman Service, so FOS, and then they will take the next steps. If you already made a complaint, the FCA has a really useful tool on their website which tells you what your next stages are. Put a link to that in the notes so you can use it. So the message is there are really important dates coming up in relation to this mis-selling scandal, and the most likely outcome is there is going to be some automatic redress. So even people who haven't bothered to look into whether they were mis-sold car finance could get compensation running into the thousands.
Okay, and so for the final piece of the podcast, we're going to be talking about Chase Bank. Now, Chase is a hugely successful bank in the UK in its own right. To give you a bit of history on Chase, it's owned by US giant JP Morgan, and it reached the UK back in 2021 to a bit of fanfare, actually, because people really liked the ability to earn cashback on their everyday spending. Now, this is cashback that you can earn on your current account. So it's not a credit card, it's your usual bank, and every time you spend money on your debit card, cashback lands in your account. Now, while it's been hugely popular, it has announced that it's going to be making some significant changes once again. So as it stands, customers can earn cashback on a wide range of transactions, and that includes transactions made abroad. But that is all going to change. So from the 7th of April 2025, Chase customers will only be able to earn up to 1% cashback on purchases made in the UK. So purchases that were made previously while you're abroad will no longer be eligible after that date in April. And it gets more specific than that. Cashback can only be earned on certain categories, and those categories are groceries, transport, and fuel. And so to break that down a little further, for groceries, we're talking about things like supermarkets and general convenience stores. So your local convenience store would probably still be okay to earn cashback on. And for transport, think about things like buses and trains. And when you think of fuel, that includes obviously petrol stations. And it also does include electric vehicle charging points, but crucially not your home charging points. What we'll do is we'll put details of exactly what qualifies for cashback going forward. We'll put that on the screen now for people who are watching the video. So just to stress, one of the most important changes here that Chase will make going forwards is where you used to get it on pretty much all your spending, albeit there were a few exceptions for gambling, etc. You won't get that cashback going forward anymore. It is only now on those set few categories. So whereas before, if you'd have maybe, purchased a washing machine at Currys, that won't be eligible for cashback anymore. It is literally just on groceries, fuel, and transport. And so you can see there it has significantly changed going forward. The thing is, this isn't the first time that Chase has made changes. If you go back to 2023, they did introduce a monthly cashback cap. So prior to 2023, customers could ultimately earn as much cashback as they wanted through their current account. But a cap was introduced in 2023, meaning people could only earn up to £15 per month. To be honest, for everyday spending, that was still generous enough, and people weren't grumbling too much about that. But last year, they made significant changes again. They moved a lot of the existing customers over to something called the Everyday Cashback Scheme, which meant that customers had to qualify for their cashback by depositing at least £1,500 per month into their account, and that would ultimately trigger the qualification criteria to earn the cashback each month. So it begs the question then, is Chase still worth it? Well, to be honest, it's a free bank account, and for anyone using it as their general current account, so long as you're depositing that £1,500 a month in there, then you can still earn a decent amount of cashback. Because let's be honest, groceries, fuel, transport, it does add up. So it is fairly generous still. But there are other alternatives out there. And because of the changes that Chase has made, it's meant that those alternatives are actually quite similar now to Chase's offering. And so we'll put details on screen of some other bank accounts that offer cashback for everyday spending. So we've got Santander's Edge showing up on screen now, and also Edge Up accounts. Now they offer up to 1% cashback, but they do have higher monthly caps of £20 and £30. So ultimately you could earn a little bit more through those, but they do have monthly fees attached to those accounts. So there is a balance to be made there. You are going to be paying either £3 or £5 per month to hold those accounts. So unlike Chase, they're not free accounts. Halifax also has a rewards account, which offers up to £5 per month in cashback. But like Chase, you'll also need to pay in a minimum of £1,500 a month to qualify for that, or else you will be paying a fee of £3 a month. Obviously, it doesn't just have to be your everyday current account where you earn cashback. Lots of people use cashback credit cards and reward cards. Damien and I, we both use them. And you can see we put a couple on screen of the most popular cashback credit cards. American Express have a couple of different cashback credit cards. The one we've got on screen is their everyday credit card, where you can earn up to 5% for the first 5 months, and then it reduces down to 0.5%, although it does go back up again to 1% once you hit a certain threshold. For that particular card, that's £10,000 in a year. We've also got the Barclaycard Rewards card. You can earn 0.25% on eligible purchases, and you can earn up to 15% cashback at certain participating retailers. Now, the benefit of going with a credit card is you do get that Section 75 protection on your purchases. That might be something you'd want to consider in addition to your cashback. And there are other perks that you'll get with some of these cards, like, for example, Amex offers a travel accident insurance when you're traveling on public transport, and you get fee-free spending abroad with some of these cards as well.
And it's worth pointing out as well that Amex has another card. You pay £25 a year and you get slightly higher cashback amount. So it's 0.75%. And then goes up to 1.25% after you spend more than £10,000 in a year. So they can work out very advantageous. You can make some really good cashback. We did a bit of a podcast recently, didn't we, Andy, where I explained how I made a significant sum in the first year of having one of these cards. One thing I will point out is that I do think cashback credit cards are one of those things that you should have when your finances are well in order. I didn't have one until just over a year or so ago, because I think you need to be okay with the fact that you regularly clear your credit card before you start trying to chase cashback rewards. A lot of people do that early doors because they say it's free money, but they are there to encourage you to spend. And so I think you need to be in a very good mindset and place for your finances before you use them. Of course, you have alternatives like cashback apps. So you have things like Jam Donut. Unfortunately, they don't accept Amex anymore, but you can use Jam Donut with your bank account or other credit cards to earn cashback on lots of different retailers. I think it's one of the most useful ways of earning cashback at the moment. And of course, you've got things like Quidco and Top Cashback as well as ways to earn cashback on purchases. And you can stack these things as well. So Andy, I think that's it for this week. I think it's a great piece. I know there are a lot of people who listen to the podcast who are Chase Bank fans who probably are a little bit disappointed with these changes. So don't forget that we've got the 500th episode coming up soon. Do send in those voice notes as Andy explained earlier. You can find more details in the notes of the show. As ever, do make sure you engage with us on our social channels. So TikTok, Instagram, YouTube. If you see something on there, like it, engage with it, comment on it, and you'll get a comment back from me. It's really important for us now to push forward with all of our social channels so you can really help us by engaging with what we put out on there. And it's also different content often than what you'll get on the podcast. So do make sure you check that out. We've got our Facebook group, facebook.com/groups/money to the masses. So all that's left for us to do is say until next time.
Until next time.